Welcome back to our special show, Decoding the Mauritius Tax Treaty. While Rakesh JHUNJHUNWALA just told us that foreign investors should not be treated as sons-in-law, that is, given special treatment and allowed to escape capital gains tax, a totally different view comes from SAMIR, an equally veteran investor, who says foreign investments made through products such as ETFs or participatory notes, P notes, would come under a cloud as there would be uncertainty on the capital gains tax and on the product itself. We began by asking Samir his reaction to both Rakesh and to the amendments in the tax treaty with Mauritius. Listen to that chat.
No, I'm not very different, but my feeling is that people are confused because they are talking about investment and whether people should invest in India even though there is tax. I happen to be in a situation like a few others where I understand both the investment part and the mechanics or the operations part.
Sure.
The current structure is operationally not feasible. So, for example, let's look at somebody who's investing in an ETF. Now, before that, broadly, please accept in black and white without any discussion that if I living in Singapore or somebody even living in Dubai, Hong Kong, or maybe even in UK, when they invest in any fund anywhere in the world, the fund does not deduct any taxes. And then when that person, if he's in London and he bought a US fund, then in his filings in London, he will, pay his taxes. It is even in US, because they cut taxes of US investors, when you redeem from the fund, they pay you back your full money. But at the end of the year, the tax authority sends a statement called K1 to the IRS saying that this fellow has to pay taxes. But in a global fund, you can't do that. So I invest personally in US funds, Europe funds, Japan funds, emerging markets, no tax. Now let's come to somebody investing in India, let's say in an ETF, where the whole selling point of the ETF is not that whether he's short-term or long-term, these foreigners don't want to pay taxes, is that the guy who redeems, are you going to tell him, A, that we will deduct a presumptive tax, which we will then give you this 10-15% after 1 year? Not a single fund in the world does it in a single market in the world. Unless it's a hedge fund type, somebody's buying illiquid stocks and all that. I'm talking about regular. Or secondly, you will deduct his tax, and then as per Indian laws, I assume that you have to deposit the tax with the authorities. And then after 12 months, you will find that the fund, which may have made money in the first 5-6 months, then because the market fell, lost a lot of money, and because the fund has to be taxed and not each individual at the end, that he has to get back that money. So structurally, it is not easy to do. It has not been done anywhere because nobody else does it. Today morning there was a conference call where one of the brokers organized and with one of these tax experts, and somebody asked him, and not me, although I've been saying it for a long time, is there any market in the world where you pay taxes like this? And the answer was, I remember a case in Argentina. Second thing is about these P notes, where I heard Rakesh talking. The question is that P note is effectively a non-starter after this, and it happens to be $30 billion. So for, your guys to say that it's okay, it's $30 billion, it's not like that, because ultimately $3 billion have to leave in 1 month, not today.
But do they have to leave, Samir? Will they not perhaps go through another route? Will they just become
let me give an example. So let me give an example. Blackstone is a US listed. It's not so when I invest or anybody invests in US, there is no tax on capital gains long-term or short-term, but there's a 30% tax on dividend income. Okay? So they just cut your tax on the dividend and nobody cares. You just give them some W-9 pen or something it's called, and you are out of the picture. But Blackstone and even Alliance Capital, these are not stocks listed in the stock exchange in US. These are partnership units. So if you buy those units, the dividend yield is very high, sometimes 7, 8, 9%. But in Singapore, not a single private bank lets you buy Blackstone units, Alliance units, because there somebody has to file taxes in US. So even though you are getting double the dividend yield, the systems outside US who don't want to file taxes, see, when I buy a US stock through any of these banks or through a broker, nothing I have to do, they will cut 30% tax on dividend received, and my responsibility is over. But if I were to buy these partnership units, which are also listed on the stock exchange, so I'm trying to tell you, just the act of having to file taxes, basically the non-US guys, not all of them maybe, but I know nearly 4-5 here, who will not let me buy those units because I will have to file, or I mean they or I but basically they, because I'll buy through them, will be responsible to file taxes as a business. So the point of tax is not straightforward.
No, so just coming back to the point about what impact this could have on the market, Samir. I take your point that, the cost of investments could go up, the lack of regulatory clarity could perhaps deter some investors. So what is the impact that this could have on the ETF money that was generally coming through the P-note route? And eventually, what impact do you think it could have in the near term on the market?
Please don't say coming through the P-note route, even if it comes from their own route. Why do you say P-note route? An ETF guy, I don't think must be coming through P-note, my guess. He must be coming on his own, because normally when you have a $2 billion or whatever X number of billion these guys may have in each, they will not use P-note because the cost of going via P-note is higher. Actually, P-note is used for people who don't want to deal with India. So mostly it's not India-centric funds because they need to, have a bigger presence, or they will have a custodian. Please note, the guy who wants to come in without a P-note, what does he need extra? He needs to set up a custodian and have a custodian in India. He needs a chartered accountant in India. Every trade has to be vetted. He has to file taxes in India. He needs a PAN number in India. Now, the guy chooses P-note because you come today and tell me that this IPO is happening. Some IPO is happening which is oversubscribed 100 times. Now, am I going to, as an FII, first send 100 times or $100 million into India because I will get 1 million? Or I will just tell my P-note issuer that I want to buy 100 million, and because it's mostly a bank and large guys, they have huge setups, that they will invest that money. So people come to India through P-note, not because they are hiding from their government or their uncles. 80-90% is because it's easier to do business. Suppose I have to borrow money to buy even more, which nearly every hedge fund does. If I am buying stock in India, who's going to lend me money? But when I'm buying via P-note, since the stock is lying with him, he lets me borrow. So whatever we may say about
will this new tax regime deter foreign investors or not?
You will have, in moving from A to B, a slippage of, could be billions of dollars, that's all.
So that's the warning. Some billions of dollars could slip out. But now, the official view from the Economic Affairs Secretary, SHAKTIKANTA.
The market has taken a very matured view of the revised, the amended protocol which has been signed yesterday. World over, General Anti-Avoidance Rules, that is GAR, it's a standard common practice which is in existence world over in all countries. India has also announced that we will have our GAR, and with regard to the implementation aspects, the guidelines, etc., these are matters which are under consideration, and I think some guidelines have already been issued, and you have to wait for the budget of next year for the finance minister to spell out what would be its final content and mode of implementation. The P-notes is a different issue altogether, and double taxation avoidance agreement is an entirely different issue on which a view has been taken, and this has been signed. On P-notes, at the moment it is status quo, and the SIT had given certain recommendations which is under internal consultation, internal deliberation. So as of now on the P-notes matter, it is status quo, there is no change.
Okay, well, actually, the entire issue of Mauritius tax treaty imposing capital gains has gotten entangled with the participatory notes issue. Now, one of the first fears of the market was that the P-note product could die. And why? Because you are the broker is the only entity which the Indian Tax Authority understands. Behind him is investor A, who has bought a share, investor B, who has bought a share and sold it, and therefore has a capital loss or gain. But the tax authority will tax only the front broker. That becomes unviable for the broker. That was the fear. But we now understand from brokers that's not difficult, that technology and SEBI have ensured that each account can be separately treated and separately taxed. Okay, so participatory notes survive. The other big problem is that you collect tax from your participatory note participants, that is the broker does, but suppose later on the tax authorities come with a bigger tax. Well, most of the brokers told us that that is not very difficult. They will be able to manage it, that participatory notes can survive and they can appropriate some money before giving it back to the investors, just to ensure that there is no googly from the tax authorities. And if there is one, they have the money to pay. So no problem, P-notes will survive. The other problem is that will it become difficult for people to access India altogether if you put capital gains on foreign participants? Most of them told us that that's not the case. P-notes will continue to survive, so access to India will remain. So what are the dangers? The biggest danger comes for those who play arbitrage trade. These guys work on very thin margins, which is, you hedge your currency and you play on the futures, stock futures or the index futures. They're paying for 1% or so. If you tax them, that product dies. So there's a genuine fear that that volume will go away from the market. So that's one negative key takeaway, that arbitrage players will not come to India. That volume may go away. The other bigger fear is this grandfathering. That is, all the investments made up to April 2017 through the P-note route will not be taxed thereafter. Not very sure. This is not because of the tax changes. This is because of the GAR or the anti-avoidance rules that will come into effect. They may say that this is an avoidance gimmick by foreign investors and therefore we will tax it. It is possible that grandfathering won't be that easy. And a third problem, likely impact, is that not just investments coming from Mauritius, but investment coming from Singapore will also be impacted. That was very clear from what Mr. Shaktikanta Das told us yesterday. So those are the three negative takeaways. The market today reacted with equanimity, but we will have to wait and see that as we approach April 2017, whether foreign investors get cold feet. With that, we wrap up this special show of ours on decoding the Mauritius tax treaty. Thanks for watching.